All right, mark your calendars, October 28th. That's the day SoFi drops its Q3 2025 earnings report. And you know what everyone's asking, right? Are they going to deliver? Well, we're going to dive deep into a pretty detailed forecast that unpacks the whole thing. The really exciting bull case, but also the one big risk you absolutely need to have on your radar. So let's get right into it.
Okay, just a quick heads up before we really get going. This is purely for informational purposes, right? We're breaking down a forecast, we're looking at the data, but this is not investment advice. We just want to make sure you've got all the angles covered. So let's get to the heart of it. The big question looming over this Q3 report is pretty straightforward. Can SoFi keep this incredible momentum going and pull off another earnings beat? I mean, that's what everyone wants to know. Well, according to the forecast we're digging into, the answer is a pretty confident yes. It's projecting a non-GAAP diluted earnings per share of 9 cents. And that number, 9 cents, is a really big deal when you see what the rest of Wall Street is thinking. Let's put some numbers to this. As you can see, this forecast is basically calling for a narrow beat, but a beat across the board. You've got adjusted net revenue predicted at $897 million, which is just a hair above consensus. Adjusted EBITDA is pegged at $295 million, and there it is again, that 9-cent EPS, which would top the market's expectation of about 8, maybe 8.5 cents. Now, these might look like small beats, but trust me, in this kind of market, even a small beat can make a huge difference. So you might be wondering what's fueling all this optimism? What's the logic behind these numbers? Well, it really boils down to what you could call SoFi's secret weapons. Let's really dig into the bull case. And the foundation of it all, the absolute cornerstone of the bull case, is SoFi's bank charter. Seriously, think of it like a massive protective moat around their entire business. It gives them this fundamental structural advantage that most of their FinTech rivals are just, well, they're incredibly jealous of it. And here's where you can really see that moat in action. On one side, you have SoFi, which, because it's a bank, gets to fund its loans using low-cost, super stable deposits from its members. You know, people like you and me. Then you look at their competitors. They're often stuck using much more expensive, much less reliable wholesale funding. So at the end of the day, it's pretty simple. The money SoFi uses to make money costs them way, way less. And what's the result of having cheaper money? Well, you get this, an absolutely stellar net interest margin, or NIM. It hit 6.01% in Q2. That is the profit engine, right there. It's fueled directly by that banking moat, and it means they're making a really healthy profit on every single loan they make. Okay, so this huge funding advantage is like pouring high-octane fuel into their core business, which is this incredibly powerful loan engine. This is where all that low-cost capital really gets put to work and starts to show its muscle. I mean, just look at these numbers. Personal loan originations up a staggering 66% year over year in the second quarter. That's not just regular growth, that's explosive growth. And it tells you that there's huge demand from the exact kind of high-quality borrowers that SoFi wants. And the momentum doesn't stop there. Check out student loans. They were up 35% in Q2, which is already great. But the real story here is what's coming next. With the Fed cutting rates and some changes in federal loan policies, pretty much everyone expects this part of the business to hit the accelerator in Q3. And then you get to home loans. Wow, up an unbelievable 92% in Q2. Now sure, it's a smaller piece of their overall loan book, but growth like that? It's just incredible. It's the ultimate proof that their one-stop shop strategy is really working. They're getting people in the door and then successfully selling them on other products. Okay, I know what you're thinking. All this crazy growth, isn't that super risky? And normally, you'd be right to worry. But SoFi has what you could call a credit quality shield. Just look at the FICO scores of their borrowers. We're talking an average of 743 for personal loans and a whopping 769 for student loans. These are prime borrowers. And because of that, their net charge-off rate stays way below the industry average. The takeaway here? They are growing fast, yes, but they're also growing smart. Now, all of this, the cheap funding, the smart loan growth, it all comes together and feeds into SoFi's grand strategy. It's something people call the flywheel effect, and it's their master plan for creating long-term, super efficient growth that's about way more than just handing out loans. And if you want proof that the flywheel is spinning, here it is. Roughly a third of all new products are sold to people who are already SoFi members. That is absolutely huge. Think about it. It means they spend way less money trying to find new customers. It's the secret sauce that makes their whole business model so efficient and their revenue so much more predictable.
So, where can we see all this amazing efficiency in the numbers? Well, you look at a metric called the EBITDA margin. Don't let the name scare you. All it really is a measure of how much profit the company is squeezing out of its main business for every dollar it brings in. It's basically a report card for how efficient they are.
And just look at this trend line. In Q2, their EBITDA margin was 29%. The prediction for Q3? A big jump to 33%. See, that's not just steady growth, that's accelerating profitability. It's telling us that as SoFi gets bigger, it's actually getting even more efficient, which is exactly what you want to see.
Okay, but let's pump the brakes for a second. It's not all sunshine and rainbows. To get the full picture, we have to look at the bear case. And when it comes to SoFi, all the worries, all the concerns, they really boil down to one single thing: the price tag on the stock.
And to talk about price, we have to talk about the PE ratio, the price to earnings ratio. All it does is compare the company's stock price to how much money it's actually making. And the rule of thumb is pretty simple. A really high PE can be a warning sign that a stock is, well, expensive.
And yep, SoFi's PE ratio is pretty high. Looking back over the last year, it's been floating somewhere between 54 and 87. Even when you look forward, it's still sitting around 69. Just to put that in perspective for you, that is way, way higher than what you'd see for a traditional bank, and it's much higher than the average for the S&P 500 too. This is what leads some analysts to just come right out and say it: the stock could be overvalued right now. What that means is the market has already assumed a ton of future success and baked it right into the current stock price. There's just no room for a misstep. It's what you call a price on perfection.
So, where does all this leave us? You've got the bull case, you've got the bear case. Let's pull it all together for one final takeaway before this earnings report drops.
Okay, so this is really the central tension you need to understand. On one hand, you have incredibly strong fundamentals, that powerful banking mode, really smart loan growth, and that super efficient flywheel. But on the other hand, you've got a stock price that seems to be screaming, yeah, we know, all that good news is already priced in. And that leads us to the one big question you need to ask yourself. There's no doubt SoFi has a powerful growth story with some very real, very durable advantages. But is that amazing story powerful enough to be worth the premium price tag? I guess we're all going to find out on October 28th.